Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, professor of economics at Ewha Womans University. Professor Kim, good afternoon. Thank you for coming on today.
Good afternoon, Devin.
Well, the big news today is the Bank of Korea becoming the first central bank in Asia to go ahead with a rate hike, up by 0.25% now to 0.75. It was May last year that the BOK cut rates to an all-time low. Tell us about this rate hike, Professor, and what you think it means.
Today's Bank of Korea's interest rate hike is not 100% expected in the market. Actually, more people have expected that Bank of Korea would leave the key interest rate at 0.5% this time because of the situation of Delta variant. Anyway, Bank of Korea's decision to increase the key interest rate indicates the end of low interest era in Korea. The two main reasons for Bank of Korea's interest rate increase are higher inflation and financial imbalance represented by huge household debt. Since Bank of Korea has changed its monetary policy from expansion to contraction, Bank of Korea will try to increase the key interest rate at least one more time by the end of this year, depending on economic situation. Particularly on the spread of Delta variant and employment recovery. But it should be noted that higher interest rate in Korea is a bad sign for economic recovery and stock market.
And you mentioned imbalances, and this rate hike comes as Korean households take on a record amount of debt, in most cases to buy homes. And despite a range of measures taken by the government to get that under control in the second quarter, debt rose to around 1.8 quadrillion won, which is more than $1.5 trillion. Some say this is like a ticking time bomb. How does this play into the rate hike decision?
As we talked about, one of the major reasons for increasing interest rate is rapidly increasing household debt, which raises financial market-wide risk in Korea. After recognizing the risk of huge household debt, government has been trying to control the increase of household debt through diverse policy tools like DSR, which imposes a strict limit on individual loan. But finally, it was not that successful at all. Household debt has continuously increased and finally exceeded 1,800 trillion won, or 1,540 billion US dollars as the end of second quarter. So Bank of Korea's interest rate increased by 0.25% this time, and another 0.25% increase next time will decelerate household debt increase. However, higher interest rate will give serious economic pain to the hardest hit people by coronavirus pandemic, like small business owners and self-employers, because these people are already sitting on huge debt to maintain their business. Government should pay more microscopic attention and support on this part of the economy.
Well, switching gears here, Professor, the Federal Reserve Symposium at Jackson Hole is this week, and ahead of that, U.S. stocks rose to all-time highs on Wednesday. The S&P up the most, about 0.2%. What's the story in the global markets?
The stock market on Wednesday in U.S. Continued its general upswing over past few days after U.S. regulators gave full approval for one of the COVID-19 vaccines. And before the good hopes from the Jackson Hole meeting, and manufacturers got additional boost as the government moved toward September vote on a roughly $1 trillion infrastructure bill. Therefore, as more investors expect the peak of Delta is close and concurrent U.S. economic rebounds, U.S. market gained yesterday. Particularly economically sensitive stocks and banks led the market to another set of fresh records. Dow Jones Industrial gained by 0.1%, and Nasdaq also gained by 0.2%. But European markets were mixed over London's 0.3% return and Frankfurt negative 0.3% return. And all Chinese market declined due to further industrial restrictions by Beijing. Shanghai lost by 0.7% today.
And today, Korean stocks were mixed as investors digested the news of the rate hike. Retail investors, net buyers on the Kospi, foreigners returned to net selling. Tell us about the domestic market.
As you said, the movements of foreign investors in domestic market became very important because they are preparing for possible tapering from the United States. Domestic market went up in early trading session this morning, but as soon as Bank of Korea's interest rate hike news arrived, market turned down to negative reason. Kospi had negative 0.6% return, but Card stock has 0.3% return today. Foreign investors are selling domestic stocks continuously related to the increased tapering possibility in the U.S. The sales of foreign investors amounts to 490 billion won, or 0.4 trillion US dollars, which is slightly larger than recent average sales amount by foreigners.
And finally, Professor, Korean lawmakers are working on next year's government budget, and what the ruling party has come up with is a proposal of around 600 trillion won, which is a record. It's well over $500 billion. That's about equal to all of this year's government spending, including the extra budgets they passed. What do you say about this budget and its sheer size?
Korean government is preparing, as you said, the largest regular budget in history of about 600 trillion won, or 513 billion US dollars for next year. If this budget is confirmed by Congress in the fall, it would mark a 7.5% annual increase from this year's budget. Government argues that this super budget is necessary to maintain expansionary fiscal policy like emergency catching out program and to stem the fast spread of highly transmissible Delta variant. But we have to remember that government budget partially financed by government debt, which is our kids' economic burden a long time after. So it is highly expected that government debt to GDP ratio, which is a barometer of fiscal soundness, exceeds 50% next year, almost for sure. So it is time to pay more attention to rising government debt seriously.
All right, Professor Kim, we'll have to leave it there for today. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you very much.